Yo, what is up, guys? So this is going to be the EP2 on liquidity series. As per promise, I will be creating whole playlist on liquidity, right? So now today we are going to talk on low resistance liquidity and high resistance liquidity. So now before understanding the low resistance liquidity, we must be understanding what are failure swings, right? So the failure swings simply occur when the price fails to create new highs in uptrend or new lows in downtrend, right? So let me show you the example to understand it more better. So now we have this high and we have another high. We failed to sweep out this high. So this is what we call the failure swing, right? So now for the bearish, if we are bearish and going for the bullish, so if you look up at this high, at this low, right? So we have created the low, but we have failed to sweep out the low. This is what we call the failure swing, right? So now let's go and understand what is actually low resistance liquidity, how to amplify the swing failures and low resistance liquidity, right? So now the low resistance liquidity run LRLR occurs when the price struggle to sweep out the liquidity and takes a long time to reach an all swing high or low, right? So let me show you the example to understand it more better. So we have this drawn liquidity key support, right? And we have this the area support level. You can be actually looking up at any item from key level, can be auto blocks, can be breaker blocks, can be any fair value gap, right? On high time from key level, right? You have to look up at this, right? But if you look up at the failure swings, if you look up at this high, we have failed to check out this high, right? And we have created another high. So this is what we call the failure swing. But if you look up at this example, we have created a high, but failed to take out this high. This is what we call the failure swing, right? So the failure swings are the low resistance liquidity on the opposite direction of the trend. So if you look up at this, we have these failure swings. So if we are moving for the buy side of the curve, we should be looking for this low resistance liquidity, which are the failure swings. Now let's understand the high resistance liquidity run. So a low that ran previous low in the buy side direction is a high resistance, and a high that ran a previous high in the sell side direction is a high resistance liquidity. So we have these failure swings, right? We have been making, right? We've been creating failure swings. It means we are now shifting the market structure to take out all these low resistance liquidity, right? Failure swings is equal to low resistance liquidity, right? So now, but if we are looking up at this buy side of the curve, you will be finding if price has been taking out the lows in the buy side of the curve, it is the high resistance liquidity. So we have created some of the consolidation. We have taken out this low. So this is what we call the high resistance liquidity. But if you look up at this consolidation, we have created some of the consolidation, took out this low. This is what we call the high resistance liquidity, right? So if you look up at this, you can find right there, and we have these old highs, which are the failure swings. It means we have this low resistance liquidity run. So let's go and get into the chart to understand it more better. So this is the chart example, right? We have the drawn liquidity. We have been shifting the structure from the key level, right? So we have these failure swings with the high and other high. We have failed to sweep out this high, and also we have this high. We have failed to sweep out it, right? And also we have some of the failure swings right there. So key level. So if you look up at this low, which acts as a high resistance liquidity. Why? Because we've been shifting the market structure. So let's go and see what is going to happen. So we have this with the low resistance liquidity run because these are the failure swings. We have this high resistance liquidity. Why? Because we are going for the buy side of the curve and market is taken out this low, shifted the market structure, shifting from the auto block, and we have successfully took out these low resistance liquidity. And again, if you look up at this low, we are on the buy side of the curve. If we are taking out the lows on the buy side of the curve, it will be the high resistance liquidity run, right? Let me show you another example. So this is another example. We have all these failure swings right there. We have been creating only lows, right? This low, and this low. So these all are the failure swings. Why? Because we have failed to take out these lows in the sell side direction, right? But if you look up at this key level, we have just touched it out and shifting the market structure, and we have this drawn liquidity, right? But if you look up at this high, we are on the sell side of the curve. We have taken out this high. It means we have this high resistance liquidity run, right? So let's see what is going to happen. So we have took out all these lows right there. We have shifted the structure right there, and we have taken out all these failure swings. But if you look up at these highs, which have been taken out, it will be called a higher resistance liquidity. Shifted the market structure again after taking out the higher resistance liquidity, and also we had these highs, which acts as a higher resistance liquidity, and simply we have shifted the trend to take out these lows, right, which is the drawn liquidity, right?